Welcome to Bunnex Investment Group. By the end of this video, you should be able to count levels from higher time frames to smaller time frames. You should also be able to predict the next market move and anticipate market trap moves. So be sure to stick up to the end to fully comprehend and acquire this skill. Firstly, let's define what levels are. Basically, levels are market impulses. If we see a market giving us an impulse to the upside or to the downside, it's actually a level that is being issued. The general market moves are, in a downtrend, we have lower highs and lower lows. We are saying if the market is actually trending in a downtrend, it creates impulse, lower high, lower low, lower high, and like that. This is inverse for the upward trend. In an upward trend, we have higher highs and higher lows. We have impulse, higher high, higher lows, like this, in an upward trend. The segments connecting two highs or two lows are what we refer to as levels. We are saying if this is actually a low being connected to this high, this particular phase is what we term a level. So basically, a level is an impulse connecting two highs or two lows. So this brings us to the market maker cycle. We cannot talk about levels without talking about the market maker cycle. The market maker cycle is made up of levels. A market maker cycle is a unilateral move before the market reverse. We are saying when the market gives us one move in a particular direction with three impulses, we expect to see a reversal. So this particular phase is what we call a market maker cycle. It is built up of three levels. Therefore, the underlying concept is the market reverse after three levels of rise or three levels of drop. At each end of the market maker cycle, we expect to see a pattern which is a reversal pattern from the traditional context of forex trading, the double bottom, the double tops, or the head and shoulders, the inverted head and shoulders, to be issued at the end of each market maker cycle. The cycle is present on all time frames, and by that we mean smaller time frames are building blocks of higher time frames. Below is an illustration of the market maker cycle. So basically, market maker cycle will always start from a low available to us on the charts. From that particular low, we'll see a level, right? Or these impulses that we've defined earlier to reach what we call a peak formation high. So these levels are related to periods. We say we can input or we can demarcate periods equivalent to a day, week, or month. If we view the chart on H1 time frame, the periods becomes days. If we view the charts on H4 time frame, the period becomes weeks. And if we view that same chart on the daily time frame, the periods becomes months. So we are saying whenever we see a day of rise or a day of drop, we consider that a level. Whenever we see a week of rise or a week of drop, we also consider that a level. And whenever we see a month of rise or a month of drop, we also consider that a level. As mentioned earlier, levels intersect and smaller time frame levels are building blocks of higher time frame levels. With that in mind, we are saying one level on the daily time frame is equal to three levels of the H4 time frame. One level on the H4 time frame is equal to three H1 levels, and one H1 level is equal to three M15 levels. To fully understand and grasp this concept, you need to see the following examples. Let's now have market examples on the charts. But before we see examples, please note that we have a free Telegram channel where we share free setups, signals, as well as trading tips. Be sure to be part of our community. Alright, so this is GBP card, or basically pound against Canadian dollar. We are going to count these levels and show you the exact same steps that you need to do whenever you are using levels in your trading. So the first thing I have done is to go on the higher time frame. This is the daily time frame that I have put my chart on. On the daily time frame, I am going to see where the market is going and attain what we call the market bias. In this particular case, we can see that our low that is available to us is at this particular point. So I'm going to start counting my levels to see how many cycles have they issued for me. I will use rectangles to mark these levels, these upward and downwards impulses. In this particular case, we can see that we had an impulse to the upside, creating this high and then creating the first low. If I can see where we can see that we have these black traces or demarcators. These are actually marking a period equivalent to a month since we are on the daily time frame. So this was the first rise that was issued. Then the second rise was from that particular point to the low that was issued, and it was also a month of rise. So I now have two levels to the upside, level 1, level 2, and I'm now expecting to see level 3, which is this one. So since I now have 3 levels to the upside like that, we now expect to see what we call a a cycle connector or a trend continuation point, which is called a reset point. So basically a reset point usually comes at EMAs that are available on my chart. I have the 250, 13 and 5, and for those who follows this channel knows these very well. So in that particular case, I now have this point as a cycle restart where I will start again counting my levels. So counting my levels, I am going to say I have this as my first month of rise after a reset was issued. There was a W pattern, first leg, second leg, and the first level was issued. From there, I had the second level, which was this one, a month of rise. Unfortunately, we can see that the market actually cleared the wall level. Whenever the market comes back to the initial point of a level, we call that point, or we call that scenario, a cleared level. Therefore, this was all consolidation and there was no rise from this particular price point to this particular price point. It was all consolidation. Therefore, I have this as my level. That is when we had a rise, a net rise. From that, we have a point. We are now in continuation. So with this in mind, what can we say about this pair? We can see that we have level 1, we had consolidation. Opening price of this phase is equal to the closing price of that phase. Therefore, this was all consolidation. With that in mind, we are expecting to see the last daily level for cycle 2 on this particular time frame. So let's now see what is taking place on the smaller time frames to see if we are doing this all correctly. If we do, we now go to the H4 time frame. We've said if we get one daily level, right? If we have one daily level, we expect to see 3 H4 levels. In this particular case, this is a level that we marked on the daily time frame. And we can see we had a week of rise to this particular point, and we saw this second week of rise. And unfortunately, the market cleared the second week of rise that we had, and this is the same scenario that we've seen on the daily time frame. Therefore, this was all consolidation. And now we had the second level of the H4 time frame, or the second week of rise, the third week of rise. This is basically verification if we are doing this thing correctly, or if we are not making any mistakes. So I would love to use a different color of the H4 time frame. I'm going to use red on the H4 time frame so that these levels can be seen with ease. So this is basically the first level, consolidation. Then this is the second week of rise, or the second H4 level, and then the last week of rise, which is the H4 level. And at the end of that, we can see a double top or an M pattern. As we mentioned earlier, that we expect to see a pattern at the end of the cycle. This was the pattern that was issued. So level 1, level 2, level 3, and from that we expect to see a reset, and we've said resets usually occurs at the 200 EMA, which is this one. So a reset, and we are now starting again. We can see the first week of rise, then we are in the second week of rise. So we are saying this is the first level after the reset and building the last daily level. The last daily level, and this is what we expect. We have said in one H4 level, we expect to see 3 H1 levels. So going on the H1 time frame, this is how it looks like. On the H1 time frame, this is an H4 level that we have marked. Let's mark it, or let's actually highlight it using a different color so that it will be clear. I'm going to use yellow. This is the first day of rise, the second day of rise, or the second impulse to the upside, creating a low. So you should be looking for lows and highs. This was a low, and at the end of the cycle we expect to see a pattern. So level 1, level 2, level 3, a pattern was issued, and from there we had a reset of the H1 time frame. From that reset, we can see that the market is initiated the first day of rise, and we are expecting to see the second day of rise to be issued today, and then the third day of rise to be issued. So basically that is how we count levels. You need to repeat this video over and over again to fully comprehend, and if you want to learn more, you can sign up for our one-on-ones to fully learn on these topics. So levels is one side, and we need to know where to make entries, the patterns that we look for within those levels. On that note, we've come to the end of our today's video. Thank you for watching, and I'll see you in the next one.